out there. We're going to be joined in by Mayuresh Joshi, the head of research for William O'Neill Company out there. Mayuresh, good morning.
Morning, Nikki. Pleasure to be on issue.
The pleasure is all mine, but I'm going to start off by asking you about your assessment on the auto pack. Eicher Motor has done well. We are seeing EPS upgrade coming in for the auto names. You think there is more steam to the rally? What's your assessment and how do the valuations stack up for you?
So to a large extent, I think if you look at the numbers delivery for the pack as a whole, I think the numbers delivery has been very, very good. If you look at the two-wheelers, Bajaj Auto gave a good set of numbers. And the commentary was equally good as well. Post June, July, they also expect the exports market portion of their entire revenue pie. TVS Motors, again, the margin performance was exceptional. They've been doing this for the past few quarters. The foray of all these players into the EV market, and again, key launches expected in the next few months and quarters, that should probably hold the earnings trajectory up for these players as well, because a large part of the capex has got gestated onto the balance sheet. And as more capex starts getting accounted for, as numbers start streaming in, you'll probably see leverage play out. Even within the four-wheelers, I think Maruti gave a reasonable set of numbers. You have Tata Motors numbers today. The expectations that the volumes will be reasonable is well known to the markets. But I think the UK operations, specifically JLR operations, are turning around to a large extent. And the impairment hits that taken a few quarters back are seemingly behind us at this point of time, as far as balance sheet concerns are probably to be seen. Even the commercial vehicle players have done reasonably well. Expectations in terms of both the MHCV market holding up, with infrastructure spending, the LCV part of the market, including the tipper market, should hold up for these players as well. As input costs, Nikki, come down for the sector as a whole, with semiconductor issues behind us, the OEM demand probably remaining intact, at least at this point of time, with the interest rate curve largely expected to be behind us as well, and the replacement market holding up. I think the OEMs on the auto space are holding up, and so are the ancillary players as well. You look at the tire companies, a very good set of numbers. Input costs have gone down significantly, which means margin expansion, which what witnessed in this quarter should probably be seen. If you see some element of price cuts, that should aid volume growth even further going forward. But the replacement market, again, holds out for these guys. Battery makers did well, and a few of the EV players as well were supporting the entire EV ecosystem. These ancillaries also probably did well. So yeah, auto as a space and ancillaries probably remain in a very sweet spot.
All right, so that's the word coming in. Mayuresh, Tata Motors will be coming up with numbers today. Do you think it's going to be better than most of the peers out there? What's your assessment, and how do you expect the numbers to stack up for the day?
So volumes are known, as I said, Nikki. I think for auto players, volumes are the known fact. I think it's only the operating part which becomes of paramount importance. Now, the Indian operations should hold up pretty well. As I said, the MHCV part should hold up well. The domestic PV segment should hold up pretty well as well. And therefore, I think the Indian operations should not be of a concern for Tata Motors. For JLR in particular, what you've probably seen over the last few quarters, the volumes is something to be looked at, specifically from a forward guidance perspective, in terms of a soft recession that is expected, both in America, both in Europe, as well as the soft uptick that you're probably seeing in China, which probably becomes one of the biggest markets. The first half can be a little bit soft for JLR, but a large element of the costs that have got embedded in terms of both the EV part of the business for JLR, in terms of R&D, in terms of expenditure towards the EV modules and platforms. I think a large part of that has been gestated on the balance sheet, and therefore I think the cash impairment that I was just speaking about in the opening remarks should be largely behind us. So I think it's all about management commentary. My own sense is that first half can be relatively softer for JLR, assuming global macros, but you should see a strong recovery coming back in Q2 or H2 of this financial year. So I think commentary is something that will do the trick for Tata Motors.
All right, so metal profile out there, the commodity, how has that stacked up for you overall? Something like Hindalco has been down and out after Novelis reported. I think is weighing down in the entire metal basket. Is it a valuation or is it the lack of interest given the performance in the previous 3 quarters of these companies?
I think valuations is no longer a concern, Nikki, for the metal pack. I think it's more in terms of the expectations of demand recovery. I think a large part of the expectations was possibly weighing in on China a couple of months back with the China unlock and the reopening trade. But the China unlock and reopening trade has really been soft. The construction activity still remains subdued in China. And so does the auto stroke ancillary activity. And therefore, I think the entire impetus that was getting expected of a huge rebound in Chinese economic activity, along with the huge stimulus that is getting that might probably get announced. I think both of them dashed hopes for metal counters in general. What really happens is China is one of the biggest producers, consumers, and re-exporters in terms of processed steel and the non-ferrous metals as well. And China probably accounts in terms of how the LME pricing will probably go about. And therefore, I think with a weak China reopening, a soft landing in the US, softness in Europe as well, I think the LME prices still remain extremely subdued. Domestic demand, no two ways about it, is extremely strong. Even if you look at Tata Steel's numbers, which were domestic operations did phenomenally well. And my own sense is with government spending, infra spending, private capex picking up, domestic spending should hold up the space again for metal counters as a whole. But generally, I think because LME prices remain subdued, even if you have a reasonable amount of volume growth, you clearly don't get that operating leverage with higher prices. And as input costs have started coming down, you expect a fair deal of price cuts to probably come through to further support the volume growth going forward. But clearly, unless LME prices show significant recovery, the pure operating leverage or a significant earnings outweigh probably remains a little bit on the lower side. Having said that, Novelis's numbers yesterday, reasonable, expecting $500 in terms of EBITDA per ton in the second half. So the first half, again, is expected to be soft for all these conditions put together. And therefore, in my opinion, I think a lot of metal counters in the next 2 quarters will brace in for the worst in terms of all these factors. They will bottom out. As I've always mentioned, there will be better opportunities in this spaces. When the pessimism is at its peak, which should happen in the next couple of quarters, I think that is the time when proper cases is formed on metal companies or counters with proper stage breakouts can probably be looked at. But I think the next quarter or two will give you opportunities in this space. Non-ferrous is something that I'll be interested on because that is one space where specifically aluminum companies, where I think a huge amount of demand expected both from the EV space and ferrous, again, a couple of quarters down the line, I think their time will come at that point.
All right, so that's the word coming in. I was a bit surprised when you said non-ferrous because much of it is linked to LME and we aren't seeing any amount of global cues coming in for that one. So that's clearly the word coming in on that one. But I'm going to quickly chat about the Zee-Sony merger, which could face another big test out there. A SEBI interim order could pose a hurdle in the merger talks as one of the SL Group companies is under the scanner for alleged diversion of funds out there. So seeing Zee not doing too well, yet another stock is down and out with losses of around 5% out there. Your assessment overall on this one?
No, so I think it's too much of a news flow, Nikki, over the last few months. You just came out of one news flow, which was probably expected to be that most of the headwinds are over, and you get one round of news flow again related to these counters as well. Obviously, I think the synergies that one expected before this news flow is a significant one. But with this news flow, again, I think there is a lot of apprehension that comes in, a lot of headwinds, whether the merger will come through, whether approvals will come through, what happens next. And therefore, there are far better counters in the broader market to probably look at. Let the news get completely gestated by the market. Let there be no headwinds left. And even after the headwinds and clarifications, if the stock has moved up, I think it at least removed that iota of doubt that anything that is acting as a baggage to these counters no longer exists. I mean, I'll be better off looking at other broader market count.
So you're clearly not going with the development which says buy on news and sell on rally. So it's not a news that we'd like to track out, or at least when it comes to Zee Enterprises out there. The stock has been behaving rather volatile. But Mayuresh, thank you so much for taking out the time and speaking to us and giving those views. It was indeed a pleasure chatting with you.